Hi, welcome to another Financials in 5. And it wouldn't be a worthy financial series if we didn't talk about that asset class that is now $2 trillion in assets, that has taken over bank lending in some jurisdictions, and it even got its own chapter on the IMF's Global Financial Stability Report. I'm obviously talking about private credit, and today we're going to look into it through the window of BDCs or business development companies who, through their listed and unlisted vehicles, lend to mid-sized corporates. These vehicles, they do bring with them the fruits of yields, but they also bring with them issues of transparency and visibility over the balance sheet. So it's a good thing that today we have both our credit and equity analysts for BDCs, Kaye and David Evans. And Ethan, I'll start with you. You did a tremendous amount of work on BDCs, and visibility is of the essence. So I have two questions for you. When you looked at non-accruals and credit performance and balance sheet overall, one, what are the main takeaways? And two, where did you get all this information?
Hey Renato, thanks for having me on. You're right, we have done kind of a lot of work on credit quality, and most of that is informed by our BDC positional database, right? So terminal users can access this on BI space flow G, and it's a database of loan level information that can give users insights into loan pricing, spreads, and various other metrics, that users can explore. So, and what we found is kind of a couple interesting things here. So, at the aggregate, credit as measured by non-accrual rates, say, looks to be deteriorating slightly. However, overall levels still look benign. What we are seeing, though, is dispersion among managers in terms of credit performance. So we've seen, certain managers who have experienced kind of spikes in their non-accrual rates in recent quarters, while, other managers have continued to operate at kind of historically low non-accrual levels. However, when we do dig a bit deeper, we find some kind of stronger indications that credit quality is deteriorating a bit more broadly, and that managers may be kicking the can a bit down the road to manage those rates lower. And a couple ways we've seen this materialize is through elevated realized losses. We've seen a higher utilization of PIK or payment in kind interest income, and we've seen some more loan restructurings than maybe we're used to in the past. So I think it's a bit of a case of kind of still waters run deep here, and I think it'll be interesting to kind of see how these things evolve going forward.
Sure, of course, that's a fantastic segue to David. David, Ethan mentioned dispersion, worsening of credit quality, some restructuring, some realized losses. How is that manifesting in the credit space?
Yeah, well, thank you, and it's great being with you all. So let's talk a little bit about relative value. And I would say that over the last year, we've seen BDCs gain a lot more respect from credit investors. Trends remain positive, excuse me, yet non-accruals are up, as Ethan noted. But for lenders whose sweet spot is mid-sized companies leverage about 7-to-1, I mean, what did you expect after 720 or 525 basis points of rate hikes? Hopping into the time machine, traveling back to late 2022, early 2023, when Silicon Valley Bank and Credit Suisse were falling apart, you would have thought there'd be a lot more Sturm und Drang in the BDC on BDC balance sheets. I think it's remarkable actually how limited non-accruals have been at this point. There may be a little bit of sleight of hand at play. I wouldn't describe it that way, but some do. There's a swathe of credit investors that might. PIK count is rising, payment in kind that is, and so too are extensions, restructurings. Forbearance, though, seems like a wise path to follow, and why not do it if that's in your bag of tricks in case you hit a rough patch. Anyway, back to your query, Renato. In the last year, we've seen spreads for large BDCs tighten by nearly 100 basis points relative to triple B financials. A year ago, the BDC universe traded like or wide to double B financials. Now the larger ones are trading closer to triple B financials. Several factors I think are at play. BDCs proved their mettle through the Fed rate hike cycle. Rating agencies have gotten more sanguine and have awarded upgrades to BDCs. BDCs have built out their credit curves, become more of a fixture in the corporate bond market. And BDCs have been smart issuers. They've avoided carpet bombing their secondary spreads with issues coming behind the spread matrix. It all kind of feels a lot like the development of the REIT market way back in the 1990s. One warning, if the market were to blow a gasket, BDCs, I think, are a higher beta sector, and they would likely move out more in a patch of volatility than the market overall.
Perfect. No, we hear you. We definitely hear you. So thank you. And with that warning, I invite all our spectators, listeners, and terminal users to have a look at BI Go and follow David and Ethan on their bio pages to get access to the latest BDC research. And if you enjoyed this credit content, make sure you subscribe so that you keep getting it. Till next time.